We are now going to proceed to the interactive live Q&A section of our webinar. I would like to welcome all our Q&A guests and invite them to come on video. We look forward to hearing your questions. We will go one at a time and I will call your names and you can direct your questions to the management team. So for the first question, I would like to invite Lance Vitanza, our research analyst from TD.
Thank you all for taking the questions and for the call. My question is, since the beginning of the year, I can count 3 weeks over which your Bitcoin acquisitions have generated negative, slightly negative, but negative Bitcoin yield. Now, I'm all in favor of buying Bitcoin even when times are tough, but shouldn't the goal be to increase Bitcoin per share at all times rather than just increasing the total amount of Bitcoin that you own? And maybe if you could just talk about the strategy or the thinking that went into those 3 particular weeks and what that could mean going forward.
Yeah, we agree with you. We don't aim to reproduce those weeks. The times that we've actually done dilutive transactions on a Bitcoin per share basis where if you go back to the crypto winter when we had to recapitalize some toxic debt on our balance sheet, we took out debt, either it was like asset-backed loans or senior debt that had EBITDA covenants that we felt were crippling the company's growth prospects. And so we didn't do it enthusiastically, but we did it because over the 10-year time frame, we knew we needed to remove those toxic elements to our balance sheet. If you look at these 3 weeks, when we took actions that were somewhat dilutive, they all were generally associated with building up the US dollar reserve. And we did that in response to analysis and feedback from the market and some reflexive concerns that we wouldn't be able to pay the dividend if the equity capital markets closed to us. So we wanted to get ahead of that and address the credit quality. So the reason we did it, and the short answer is we do it to improve the credit worthiness of the company. And if we felt that there was a credit problem, we would do it. Right now, we feel that we've built the US dollar reserve to the level where we don't have a credit problem. We're good for the next few years. We don't have any of those other forms of debt, the senior debt or the asset-backed lending. So the balance sheet is in much better shape today. Going forward, we wouldn't electively or programmatically issue equity to buy Bitcoin if it was going to decrease Bitcoin per share. Right, where we don't think that's a good idea. We would only take those actions when we feel like it's essential to defend the credit of the company, because if people lose confidence in the credit, then that will ripple into losing confidence in the equity and then losing confidence in the business model in general. So it's a practical consideration. But I don't think we expect to see anything of that magnitude going forward, because the first $2.25 billion of US dollar reserve was a big move.
And just if I could just get a follow-up question regarding that $2.5 billion cash reserve. Could you, in theory, use that if you chose? Could you use that to redeem the $1 billion of converts that are puttable in September of 27?
Yeah, we could. We could use it for any corporate purpose. We could use it to pay dividends. We could use it to meet a credit obligation. We could use it to pay interest on a loan. We could use it for whatever.
Thank you.
Great. Thank you, Lance. For the next question, I would like to invite Tom Lee from Fundstrat and Bitmind.
Hi. Thank you, everybody. Really useful presentation. I took a ton of notes. But I want to ask you a 2-part question. I apologize. It's 2 parts. On slide 53, you talked about quantum vulnerability of Bitcoin. And I apologize. I know it's getting a little nerdy, but I know a lot of people have questions about quantum vulnerability because, of course, Bitcoin could upgrade its network. but I know there's three types of wallets that remain quantum vulnerable. One is Satoshi, because he used a pay to public key, a really old wallet. And then anyone who's sent Bitcoin reveals their public key. And then, as you know, the Taproot wallets actually are somewhat quantum vulnerable. So I think that's like 25 or 30% of all Bitcoin wallets out there. So the part one question is, I know MicroStrategy is a security expert. You have so much experience in security. Could you give us some idea of how Bitcoin and the core developers might think about addressing the quantum vulnerable wallets? But the second part is, that's really a small part of the story, because there's only 4.4 million wallets that have even $10,000 worth of Bitcoin, which means whereas there's almost 1 billion accounts globally that have $10,000 of stocks, bonds, or cash, meaning the world hasn't really adopted Bitcoin yet. And so, as you think about the rest of this year, could you give us like what you think are some milestones or roadmaps that further drive Bitcoin adoption, which in turn help the price of Bitcoin?
So with regard to the quantum question, I don't think it's appropriate for us to advocate a particular solution or a particular approach, nor a particular time frame. I think that our role is to support all of the various communities and facilitate the evolution of consensus about what should be done, how it should be done, when it should be done. And I think that if you accelerate those and pressurize those processes, you end up solving a bunch of problems that don't exist in a way that maybe are iatrogenic. So we don't have a particular set of policy points that we wish to advocate right now, nor do I think it's really responsible or appropriate for us to do that. I think that that will be emergent. Exactly what should be done. By the way, it's not clear anything should be done ever. It's quite possible we'll actually pop out. You remember, the world was going to, end in climate change, death, 26 years ago, and 26 years went by and none of those things happened. We were going to, Bitcoin was going to boil the ocean, use all the energy on Earth as late as 2018, and that never happened. So it's possible that whatever happens in the quantum domain will actually improve the security of the Bitcoin network inadvertently before we have to even discuss a protocol change. So I don't think there's any particular policies to be advocating right now other than to support all the various communities and facilitate consensus at the right time to do the right things. The second topic is really, what are the catalysts for Bitcoin price to improve? Look, I think the fundamental catalysts are regulatory support. We have the most constructive set of financial regulators in the history of the industry right now. The head of the Fed, the head of the Treasury, the head of the CFTC, the head of the SEC, and the White House has a digital assets czar, right? Those 5 things are massive bull flags. They're all very positive, and generally you would expect that something good will come probably out of the CFTC or the SEC as they are constructive about facilitating financial companies to innovate in the digital asset space, right? I would have been skeptical about that 2 years ago, but I think for you to be skeptical about their support for digital innovation today would be ignoring all the words from everybody in those positions. And I think that the second catalyst will be banking adoption, the formation of the banking credit networks. As the large banks and as companies like Schwab, they start to allow you to trade Bitcoin, custody Bitcoin, borrow against Bitcoin. They're going to legitimize the asset, and they're going to decrease the volatility of the asset. They're going to improve the usefulness of the asset. you're aware of the announcement of the BlackRock Bitcoin Volatility Income Fund that came like about a week ago, where they said they were going to sell volatility or generate income. And there's a lot of people that speculate that will decrease the volatility of Bitcoin and put a more stable floor into the asset. So I think the actions by big finance, the actions by the big banks, and the actions by the financial regulators are the fundamentals. I mean, those are the fundamental things. And if you were to light a candle and pray, to the gods of the crypto sphere, you would say, I want pro-digital assets regulators, I want pro-digital assets banks, and I want pro-digital assets financial innovations like BlackRock's bringing to the market, like we're bringing to the market, right? Like STRC. But fundamentally, the industry is going to move forward because of enlightened regulation, engaged, thoughtful banking, and then innovative finance. And that's what we're doing, and that's what we see right now.
Great. Thank you, Michael.
Thank you, Tom. For the next question, I would like to invite Pete Christiansen from Citi.
Thank you. Good evening. Michael, I want to talk about events of the last week. On Friday, the president presented his nominee for next Fed chair, which exacerbated volatility across a number of asset classes, including Bitcoin. The good news is Kevin Warsh is on the tape noting that Bitcoin is the new gold. So that's good. But I guess my question is, how would Strategy's capital allocation framework, or possibly if it would change, if the next Fed chair is perceived to be less independent, perhaps maybe more tolerant of fiscal dominance, that may raise Bitcoin prices short term, but longer term, it may introduce increased rate volatility, which may be a challenge on the funding side. I'm just curious if you have any perspectives on how that might change the capital allocation framework for Strategy. Thank you.
We try to be very reactive to market signals. So for example, when our equity trades weak, we don't sell it. When our credit instruments are trading weak, when the cost of credit is too high, we don't sell them. The most obvious is STRC. If it trades below 100, we don't sell it. So in periods where the marketplace loses confidence in our particular credit instruments, we simply wait. And in periods when the MNAV of the equity explodes to 3 or 3.5, we might sell $1 billion a day. Right. So when the capital markets are enthusiastic about either the equity or the credit, we react to them. And it's above our pay grade to set financial policy. It's even above our pay grade to interpret like the financial policy. Like sometimes the macroeconomy has one set of numbers and you would think it's good for Bitcoin, but it's bad for Bitcoin. Or another time you would say, well, if they do this, that should be good for us, and it's not good for us. And then other times it's the opposite. I think the nice thing about our business is we have the option to do nothing, and we have a set of disciplined capital markets programs. They've moved from being discrete, where it's like, well, we got to do a deal this quarter. What's the deal we're going to do in Q3? And we've moved from discrete 144A capital markets programs to continuous ATM type programs. And with the ATMs, if the market thinks, that the cost of capital on an instrument like STRF should be 11%, well, we just don't want to sell it. So we think it ought to go to 8%. So when the market takes STRF to 140 or whatever the price it is that we think is fair, then we will be open to issuing more. And when the market is bearish on those instruments, we don't. And the good thing about the business is, if you think if you think Bitcoin is going to grow, fill in a number, 30% a year, then our option is just do nothing. And we're a company that's a $45-50 billion company growing 30% a year. So that's our default. Our default, if you think Bitcoin's only going to grow 10 or 20% a year, our default is we just do nothing and we grow at the rate of Bitcoin, and we're okay with that. And then if we think that there's something very accretive that's going to be good for the shareholders, then we will participate. And we can participate, in size $1 million a day, 100 million a day, $1 billion a day. And the truth is, Pete, sometimes we get up in the morning and we basically set up our programs and we think, well, nothing's going to happen today. And then 5 minutes before the market closes, a lot of stuff happens. Like it can literally change in 60 seconds. And again, that's beyond, our control. We can't control how the markets will interpret all these things. What we can do is set up a rational set of credit structures so that we only issue credit when we think it's in the best interest of the company, and we only issue equity when it's in the best interest of the company.
Thank you, Michael. Fair and helpful comments.
Thank you, Pete. For the next question, I would like to invite Lyn Alden from Lyn Alden Investment Strategy.
Thank you for the opportunity. Given the popularity of STRC, my question's focused on that. The company established that USD reserve, which I think shored up the confidence of these products and make them more attractive. Right now, the USD reserve is on the website 30 months of coverage compared to the dividends of the preferreds. The other preferreds are fixed dividends. STRC is a variable dividend, which introduces some degree of uncertainty around how many months of coverage there are for the total amount of dividends payable. Do you have any kind of views on what you think is an appropriate minimum reserve relative to months of dividend coverage? Or do you have a kind of a maximum that you'd be willing to pay on a dividend for STRC? And then a related question is, we are seeing some kind of early financial products that are out in the market that are looking to potentially leverage STRC, given the goal of low volatility and high yield. Are you monitoring the space for leverage built on top of that as it could contribute to spikes of volatility should there be an issue in the market? And do you have any? Would you encourage that kind of thing, or would you dissuade leverage from building on top of that increasingly kind of popular product? Thank you.
I can start, Lyn. Thanks for the question. First, we said that we target 2 to 3 years of dividend coverage with our US dollar reserve. So we wouldn't want it to go below 2 years. I think 3 years would be pretty high. And as far as whether we think there's a cap to the stretch rate, we're pretty early on and we're sort of trying to understand what happens every single month at the end of the month. And that's why we have our guidance that we have, right? It's at 11 and a quarter. Could we take it to 12 potentially? But it's going to be a function of how do we keep the price within a tight range right around that $100, and also a function of what happens to interest rates in general. But I don't think we have a cap right now. We're just going to have to see how this instrument plays out over time. So that's the answer on stretch overall. And your second question, remind me?
The second question was around, we're seeing kind of early products potentially looking to lever it up for other customers. Do you perceive issues in that? Are you monitoring it? Would you encourage or dissuade that type of activity?
I think anytime people create products on top of stretch, right? There's some products that we've seen like Buck that have been issued that are, they're not levered products, but they're actually reducing the volatility down to about 0. And they're actually showing daily accruals as opposed to monthly accruals. So I think those are positive. I think to the extent people are going to build levered products, one, we can't really, we're not going to stop them. And I think leverage adds liquidity, adds a certain extent interest in stretch. And we'll see how it plays out over time. But I don't necessarily think that's a bad thing.
Thank you for the clarifications.
Okay. So we can move on to the next question. For that, I would like to invite Mark Palmer from Benchmark.
Thank you. A couple of questions. First of all, we have seen over the last year a tremendous number of new digital asset treasury companies formed. Many of them focused on accumulating Bitcoin, others on accumulating other crypto tokens. What is your take on how this industry is likely to evolve in terms of the number of players, whether there's going to be a shakeout? If there is a shakeout, will there be consolidation? And most importantly, what could this all mean for strategy as it unfolds? Are there opportunities for the company to take advantage of that dynamic?
I think every business has to have an operating model that works, that adds value if it's going to grow and prosper. So one model is just to provide Bitcoin exposure if people in the country in question can't get it any other way. There are a lot of people in the UK that bought our stock for 4 years because they just couldn't buy Bitcoin any other way. So if there's a value proposition, in Brazil or in France or wherever, then maybe just you can be a simple Bitcoin holder. I think another value proposition is to issue digital credit, and you can see that Strive and Metaplanet have both pursued digital credit. If you're good at it, by the way, you can do digital credit and not be good at it, right? If you take on debt you can't pay back, right? Then that doesn't help the company, that hurts the company. But if you're good at digital credit, that could be another case. A third would be anything that uses capital, right? So if these companies, if they want to generate Bitcoin yield, they're going to have to find some way to generate a benefit from the capital, right? You could underwrite insurance. You could support trading or derivatives trading by posting it as collateral. You could engage in derivatives trading, right? You could literally become a public company with a lot of capital that trades in the digital derivatives market, posting your Bitcoin as the collateral to take the trade and sell the volatility. It's a different business model. What do I think? I think there's thousands of companies that get launched. Many don't succeed. Some will fail. Some get launched doing one thing and then they evolve into something different. Like look at our company, we evolved. In fact, you could argue that the most successful companies evolved through 2, 3, 4 stages in their life cycle. I mean, Apple didn't start out as a phone company for sure. And I think Elon, maybe he ends up being a robot company and not a car company, right? At Tesla. So I think that the winners will evolve and they'll find a niche. And I think that the ones that don't evolve, if you're just a holding company, holding Bitcoin, not doing anything with it, might you get bought up? Yeah, you might get bought. And would that be good for you? You're a lot better off, if you have something people want to buy. For example, Sears, had a future because they had a lot of real estate that somebody wanted to own. And if they didn't own the real estate, it would have been a much worse situation for them. So I think that you're going to see all sorts of examples now, and presumably thousands and thousands of companies get launched, and they all do different things. And we're very embryonic early on, like in the first year or 2 years. 50 years from now, right? I mean, the debate will be who's the best Bitcoin-backed insurance company, right? But 20, 30, 40 years from now, and that company doesn't even exist right now. But on the other hand, what about us? Are they opportunities for us? Well, they were an opportunity for Strive. Strive did the deal with Similar, and they closed it quickly, and they were able to build their capital base pretty rapidly. So that's, we see examples of that. There probably will be some mergers and acquisitions of other companies in various space if they put together their various assets in a synergistic way. Our business is laser-like, monomaniacally focused on one thing right now. We want to make Stretch, STRC, the premier credit instrument in the digital world, the best digital credit in the world, and maybe the best credit in the world. If we can create a product that trades with less than 5 vol, that pays you 10% dividend with a stable $100 value and we pay a rock dividend, the question is, who would want that? It's like everybody would want that. Why? I mean, why wouldn't you want it? Like, what's the demand for that? It's infinite. So effective. If Stretch works, it's the ideal product, and the company that can create Treasury credit based on digital capital has the ideal business model. And so we generally won't get distracted, right? The number one risk for us is a dilutive distraction, right? Everything else on our capital structure that undermines the credit of Stretch, is a question mark, right? So you have to be thinking about that. And then anything we might do that looks complicated or risky or different would anything that introduces a question in the mind of the Stretch investor, can we pay the dividend? That's going to be deemed negative. Anything that introduces a question in the equity investor's mind, can you outperform Bitcoin? So generally we're pretty skeptical on acquisitions because they take a long time, and then you might acquire something that you didn't want that you have to divest, and then everybody wants to talk about how and why and how long it takes. And so I wouldn't say it's not a good strategy for other companies and other investors. There are other companies and other investors for which it's a great opportunity for them, and they can make a lot of money and they will pursue it, and God bless them. For us, we believe we've stumbled upon maybe the most promising product, STRC. After 20 capital markets transactions and all sorts of credit instruments, we think we found the best one for us and for the credit investor. And we think we found a great business model, right? The Treasury company, if you can generate return of capital dividends scalably and scale up the issuance of Treasury credit, you've got maybe one of the most efficient business models in the world and one of the most compelling products in the world. So we don't want to do anything that would dilute that focus, undermine the credit of the balance sheet, or distract the management team from what we see as a once in a lifetime opportunity.
Thank you.
Great, thank you. For the next question, I would like to invite Larry Lepard from Equity Management Associates.
Yeah, hi, thanks for having me on, guys. First off, two great things in my view came out of the call. One, the whole guidance on the STRC rate. I mean, that's brilliant. Really love it, and it's going to help people like me who are buying STRC, as kind of, a solid retirement type of asset to understand where it's going. And I have a question related to that, but I'd like to put it to the end. The second thing that I thought was really important was the notion that you're going to upgrade and play a leadership role in the technical direction of Bitcoin. I think that's fabulous and a great way of addressing all the FUD around quantum, which I think has probably scared off a few of the bigger institutions who are looking at it. They're kind of saying, hey, who controls this whole thing? Just back to first principles, I want to just kind of run through how I look at this and see if you as a management team agree. I'm a value investor. I look for asymmetry. And in my view, right now, MicroStrategy is the most asymmetric value investment in the world. And most people don't understand it. And it's kind of stunning to me. My partner, David Foley, and I, we did a model. We've done several models, and we've looked at it and said, if Bitcoin stays at $50,000 for 4 or 5 years, you can't break this company. It's unbreakable. I mean, the dilution, we calculate the dilution would maybe be 15 or 20%. So the downside case here, in our view, is really covered, as a result of the fact that the debt's unsecured and the interest rate on it is very, very low. Some of it's convertible, as we all know, and the preferred is really equity. So to me, you've got an unbelievable situation. I think a lot of people listening to this call are kind of wondering, hey, what's going on with the stock price? What's going on with Bitcoin? My view on that is just that what's going on with Bitcoin is liquidity is really tight. And, this is what's going to drive a big print at some time relatively soon. And it's also what's driving the stock market down. And Bitcoin has always been kind of a leading indicator of where, how much liquidity is out there. And so, things are tight right now. And you see it, gold's getting hit, silver's getting hit, all the sound money assets are getting hit. But we know the debasement trade is alive and well because gold and silver have just been on a tear. And this reminds me very much of 2020 when gold and silver led first and Bitcoin followed harder. Bitcoin went up 6x in October of 2020 after gold had gone up 45%, when Powell pivoted and then COVID came along. So, to me, what's going to happen here is this thing is going to be, a 2-bagger, 5-bagger, 10-bagger, and most people don't really understand it. And the reason that's the case is kind of said, where he said, commodities are a very, very hard business to invest in because they have long cycles, and the average investor, who's being marked quarter to quarter, month to month, year to year, can't show long time preference. He didn't use those words, but he was essentially saying the same thing, which is Saifedean's point. And, if you have the long time preference, you realize this is a commodity that has a fixed supply. The asymmetry, it's absolutely blowing my mind. So I just want to say congrats for all you're doing. And I think it's, a no-brainer that this is going to be a outstanding upside investment. I do have one specific question related to the stretch product, and that is this. You're going to adjust it. Okay, so maybe you have to adjust it in a while to get more people to buy it. Fine. At some point, this is going to be a fabulous product. Everybody's going to want it. And if you kind of set the price at 100, could it ever adjust down? I mean, I'm buying it and I'll probably gift it to my kids because the tax basis will be 0 and I'll never sell it. Could you think about setting a lower boundary on the yield? 11%, that's attractive. 9, 8, 7, those are all attractive. If it got so attractive that the yield on it started to go down to 5, 4, 3, 2, 1, that would be, if people looking at buying it, thinking long term, might wonder, is there a boundary below which this thing can fall? And we'd be more comfortable buying it if we knew there was such a boundary on the yield.
Yeah,
Go ahead, Phong.
I can start, Larry, and we agree with all your points. I think there's a significant misunderstanding of the leverage on the balance sheet and how we're going to service our convertible debt over time, and these ideas that if Bitcoin price goes below our cost basis, that becomes an issue. And as I stated, Bitcoin needs to go down to $8,000 a coin and sit there for 5 years up until 2032 before we really have a problem being able to satisfy the convertible note. So thank you for pointing that out. On the rate on stretch, right? Right now, technically the bottom of the rate would be SOFR, but we think of the fact that we get capital from stretch, we put it into Bitcoin, and Bitcoin is going to go up on average 30% a year. So anything that we pay less than, call it 20%, is accretive to our shareholders.
Right.
So I don't think it's something where you should sit there and think that we're going to drive it down to SOFR, right? If stretch price goes to 100 and sits at 100, we might take it down a couple percentage points, but I don't think, and obviously it depends on where SOFR goes, but I don't think it's something that someone should think we're going to pull the rug out from under folks and drive it down to 1.
Yeah, I think stating that publicly to, people who are buying stretch would be important, just so people understand. And if you were to say something along the lines of, we're not going to let it go below 7 or something, because it's going to get to be really popular at some point in time. And those of us who are buying it with multi-decade timeframes, right?
Yeah, another point to make is we can't lower the rate more than 25 basis points a month. So we're always going to be very incremental. And we would only lower the rate when in such a way that we thought it would stay in that zone of 99 to 101. Like we want to keep it targeted at 100. So, you might 5 years from now find out that the rational credit spreads that the market assigns us are 300 basis points instead of 600, and that people would like to buy this thing at 400 basis points over SOFR, maybe. But we would very gradually get there, and we would still expect STRC to be trading around 100. And so we're not looking to do anything that is jarring to the price. We want the price to be stable. As a practical matter, the reason that we would lower the dividend rate would be we had such an avalanche of demand. We had too much demand, and people want to buy infinite, and we don't want to sell infinite because we'll drive the BTC rating of STRC down. Right? Like if hypothetically someone said, I want to buy $100 billion of STRC tomorrow, you can see how we don't want to sell it because right? Yeah, because then that reflexive and that would undermine the credit quality and that would increase the volatility and that, that kind of works against everything. So luckily for us, and practically that's not going to happen, right? Like, they say, it's good that we have time because otherwise everything would take place at the same time, right? All at once. We don't want stuff to happen all at once. So it will happen progressively. We'll be very thoughtful about it. Our goal is always for it to be extremely compelling to attract capital. And at the point where we feel like we've got too much capital, it would be a circumstance, Larry, where there was massive success of STRC and Bitcoin was lagging and MSTR equity premium was lagging. And there's that weird situation where it's hard for the company to increase its collateral base in order to back the credit. And then we would say we have too much demand for the credit, so we need to click it down. But if there's over demand for the credit, it would still be pegged at 100 when we take it down 25 basis points. And so we're going to responsibly manage this so as to minimize volatility, maximize stability, and in all likelihood, it's going to be excessively compelling in terms of dividend rate for quite a while, because even though you believe in Bitcoin as collateral and I believe in Bitcoin as collateral, we've got a lot of work to do with credit rating agencies and the Basel rules and traditional finance establishment before they recognize it as being good collateral. And as long as they don't, then that means probably the spreads are going to stay pretty compelling.
Fair enough. Thank you very much. Really appreciate it.
Thank you. For the next question, can we have Andrew Harte from BTIG?
Hey, thanks for taking my question. So it'd be great to hear some examples of some of the doors that have been open since Strategy got a credit rating back in the fall. I think it's potentially opened doors to pension funds, insurance companies, and other really large institutional investors. And Michael, before we got on this webcast, you said something like times today that we're seeing with Bitcoin is when people are looking for insight and leadership. So I guess who better to ask, right? What is your expectation for conversations with these new potential investors with these really large pools of capital? If you could also shed some light on how the conversations to date, since you've gotten that credit rating, have evolved. Thanks.
Yeah, I can cover. Sorry, go ahead, Andrew.
I was going to start, and Phong, please jump in. Look, Andrew, thank you for the question. I think the process with the rating agencies was an excellent process. I think we've noted that we've had a credit rating in the past. It was more based on the legacy business. This is the first time a Bitcoin Treasury company with a framework specific to that was rated by a major credit agency. I think overall, the reaction has been what we had expected, right? Like there is now a public profile that investors can look to. It is opening up, I think, interest. I think it's still early though, right? I think a lot of us that have been in these types of markets know that the credit rating agencies take time to develop. I think we noted earlier in the presentation that we believe we've made strides since the relaunch of the rating that we'll continue to make progress. I think there's more to do in that sense, and it's sort of created a little bit of a floor, so to speak, because everything we do here will be incrementally increasing the capital base. It'll increase our ability to strengthen our balance sheet. And so I think in the long run, it may take longer than it would take a near-term action, but I think that there's possible upside. I think that will continue to drive more large institutional demand. And to answer your question, I think the reaction from the investor base has been net positive, and certainly the cash reserve has added on to that as well.
Thanks, Andrew.
Thank you. Yeah,
Mike,
go ahead.
do you want to cover the second question around just general Bitcoin?
Just restate the question again.
I was wondering how the conversations you've had with these really large pools, really large investors have come along. And then, before we got on, you said times like this is when people are looking for insight and leadership. And so as you continue to have those conversations with people that are new to Bitcoin, what do you tell them in a day like today?
I think we've got an unprecedented number of invitations to financial conferences and meetings with investors in general, and I think that the amount of interest in this topic explodes, and when the volatility explodes, the engagement explodes. What I would tell them is the same we've kind of said for a while. Bitcoin's capital investment, your time horizon needs to be minimal 4 years. I would actually say, look at the moving 4 year, the simple moving 200-week average, the 200-week simple moving average, or the 4-year average. And I would invest like with a 4-year DCA, dollar cost averaging type approach if you're going to invest in Bitcoin. And you really want to have the intent to hold the product, hold the asset for a decade. And if you can't if you can't wait a decade with no cash flow, and if you can't stand the volatility, then I would say you ought to buy the credit. If you believe in digital assets or digital capital, you believe in Bitcoin, but you can't stand to wait for a decade and take the vol, you should buy the credit and just take the 11% tax deferred, with much, much less volatility and with someone else stomaching the pain for you. And so I think it's kind of simple, right? You either don't believe in Bitcoin at all, and then you don't want the credit or the capital, or you believe in Bitcoin as a maxi and you want the equity because you want 2x Bitcoin, or you want Bitcoin as as sovereign, censorship resistant, long-term store of value to give to your great grandkids, who may be living in a country you don't even live in right now, and you want to self-custody, then you buy the Bitcoin. Or you just think all this stuff looks really good, but you need the money back in September, then you think about the credit, right? And specifically the Treasury credit, because the other credit instruments are too complicated. So I would say we're really at this point pitching the Treasury credit, as the first step in a Bitcoin journey for a traditional or conventional investor who believes in digital assets.
Thank you, Michael.
And we're pitching it to a lot of people. Like, we're talking to a lot, right? So there's a lot of conversations. And if anything, right, the volatility right here is the reason why you might want to have a product like STRC. If you're wondering, what's the justification? Well, just look at the two charts next to each other and you figure out why you might want the credit instrument.
Great. And for the last question here, I would like to invite Dan Hillery from Buck.
Hi, Shirish. Thanks for having me on, guys. So my question is as follows. The de-equitization of the convertible notes has seemed to be a bit of a headwind for the cost of capital across all the preferred equities. And if MSTR continues to trade below the convertible note conversion price, how many months before the put date would you guys consider refinancing or retiring the converts at a discount in order to lower the cost of capital across all the digital credit instruments?
Dan, we went through this in 2022 during Bitcoin winter, and our converts were at some point in time trading at $35, for each. And we.
It means 35 cents or 40 cents on the dollar.
35 cents on the dollar. And we had considered whether it made sense to, call to buy some of those back. And it never really made a lot of sense, especially if you live in a world where you think Bitcoin price is going to go up. So the converts aren't really this big overhang for us. And as I mentioned, you need Bitcoin price to go down to $8,000 and sit there for 5-6 years before it really becomes a problem. So it's not really something that we think about a lot of whether we're going to buy back any of the converts or if we're going to do something early with them right now.
Yeah, I would say a year before we have a put event, or a year before we have a redemption event, we certainly look at it. We look at the statistical likelihood of anything. and then we evaluate whether or not it makes sense to refinance or hedge or mitigate anything. And if we were to do it, we would want to do it 6 months before the event took place. So, but right now we're still far out of that window, and it's not clear there's any event. The last time I looked at one of our puts, it was the one that was coming due earliest. The bond was already above par, and so there is no risk to it. So when we get to certainly when you're more than 1 year out, it's all hypothetical, worrying about something that's unlikely to ever happen. When you get to 1 year out, you have to consider whether there's a risk, and then we're certainly not going to wait till 1 month before we deal with the risk. We wouldn't wait till the last few weeks or the last few months. We would probably do it with a few quarters buffer at the latest, which means we start thinking about a year before.
That answers my question. Thanks.
Great. Thank you, everyone. This concludes the Q&A portion of the webinar. I would like to thank all the guests for their questions and all the attendees for tuning in live. We had over 3,000 people join us live on Zoom webinar, over 4,000 people on YouTube live stream, and over 180,000 views on X live stream. So this should be one of the most viewed earnings call in our history. So appreciate all your interest and curiosity, and thank you. I would like to now turn the call over to Phong for final closing remarks.
Look, I want to echo everyone's thoughts. Thank you for the analysts for joining us. Thank you for everybody for dialing into the call and listening. And thanks for those who are joining us online. I invite you all to join us in Las Vegas, February 23rd, 25th at Strategy World and Bitcoin for Corporations. And if we don't see you there, we'll see you again in 3 months in our next earnings call. Thanks, everyone.